Okay, so imagine this. A company that, kind of quietly, powers the global aviation and defense industries. Not by building the biggest planes or the, fanciest weapon systems, but by dominating the essential, often unseen parts that keep everything running.
Right, the critical components, the things you don't think about until they don't work.
Exactly. And this company, it grows not through flashy breakthroughs, but through this really methodical, almost relentless focus on niche markets.
It's a fascinating model. These are often the most durable businesses, the ones with those deep, almost invisible competitive moats. Very hard to replicate.
A hidden powerhouse.
Why not?
And that's precisely why today we're taking a deep dive into HEICO Corporation, ticker symbol HEIA.
And IKEA. Yeah, they're a fascinating case study.
Absolutely. This isn't just about one company. It's really a study in business strategy, competitive advantage, and long-term value creation in these really specialized sectors.
Yeah.
Aerospace, defense, electronics.
So our mission today is essentially to unpack a pretty comprehensive investment analysis of HEICO. We want to pull out the most important nuggets of knowledge and insight for you.
We'll dig into its unique business model, the really strong competitive barriers it's built up.
Which are considerable.
Right. And its remarkable financial track record, plus the strategic engine that just keeps fueling its growth.
And hopefully you'll have some aha moments as we explore how this dual segment structure, this kind of regulatory fortress they've built, and a family-led management team have created a business that just consistently beats expectations.
Even if it comes with that premium price tag we see in the market.
That's the trade-off, right? But understanding ATRO, we think, is a bit of a shortcut to getting informed about the hidden mechanics of these absolutely critical industries.
Okay, let's get started. Understanding the HEICO machine, business model and structure. So you painted this picture of a company kind of hiding in plain sight. Let's lift the hood then. What actually makes the HEICO machine pick? It's not just one single thing, is it? You mentioned a dual segment structure.
That's exactly right. It's not monolithic at all. What's really interesting about how HEICO works is how they leverage two distinct but actually quite complementary operating segments. It creates this really robust, diversified business.
Okay, what are they?
So on one side, you've got the Flight Support Group, or FSG, and on the other, the Electronic Technologies Group, ETG.
Right.
Now, they cater to somewhat different end markets, but both segments really stick rigorously to HEICO's core philosophy, dominate the niche.
Okay.
And if you look at the numbers, the revenue split between them, it's actually shifted quite a bit recently. Go back to fiscal 2021, it was almost an even 50-50 split.
Huh.
But fast forward to fiscal 2023, and FSG had grown to account for a pretty substantial 60% of consolidated net sales.
Wow, 60%. So that really points to, what, a big surge in commercial aerospace.
Exactly. It clearly underscores those powerful tailwinds that commercial aerospace has been riding, especially in the post-pandemic recovery phase.
That's a huge swing in just 2 years. Let's really dive into that segment then, the Flight Support Group, FSG, because you said it's the backbone of their commercial aerospace business.
It really is.
And the claim is they're effectively the world's largest manufacturer of FAA-approved jet engine and aircraft component replacement parts other than the OEMs themselves. That sounds very specific and powerful.
It is, and it's a crucial differentiator. It really underpins so much of their competitive advantage. The core of FSG's business revolves around something called PMA parts.
PMA.
Parts manufacturer approval. Simply put, these are functional equivalents to the parts made by the original equipment manufacturers. You know, the Boeings, the GEs, the Pratt & Whitneys.
Okay, so like the brand names.
Right. But here's the key part. HEICO offers these PMA parts at a significant cost saving to airlines and other operators.
All right.
You can see the value proposition there, right? If you can get an equally safe, equally reliable part for less money, well, for a cost-conscious airline, that's a very compelling argument.
So it's almost like a high-quality, rigorously tested, generic version for incredibly complex aircraft parts. That sounds like a killer value prop.
That's a good way to think about it.
And they're not just dabbling. The sources mention a huge portfolio. Just how extensive is it?
Oh, it's massive. We're talking approximately 19,500 different PMA parts in their portfolio.
19,500.
Yeah. But what's maybe even more impressive than just the number is their product development engine. This isn't static. They are consistently adding between 350 and 550 new PMA parts to their catalog every single year.
Wow. So constantly expanding their reach.
Constantly. This continuous expansion is absolutely key to their ongoing market share gains. And these parts, they fall into different categories too. You have rotable parts.
Rotable.
Yeah, like the name suggests, they can be repaired and reused, pretty much indefinitely. Then there are repairable parts, which have a limited number of repair cycles. And finally, expendable parts, basically single use, replaced after their lifespan.
So they cover the whole spectrum of maintenance needs.
Exactly. A very diverse offering.
Okay, so beyond just making these critical PMA parts, FSG also offers repair and overhaul services. That feels like a really natural fit, right? Leveraging their engineering know-how.
It absolutely is a very logical extension. They provide comprehensive repair and overhaul services for a huge range of aircraft components. Think complex engine parts, sophisticated avionics, instruments, flight surfaces.
The works.
Pretty much.
Okay.
And a particularly important piece here is their proprietary DER repairs.
DER.
Designated Engineering Representative. These are FAA-approved alternative repair methods. They often provide airlines with even further cost savings and more engineering flexibility. Sometimes they find smarter, more efficient ways to fix a component that might otherwise be scrapped or need a super expensive OEM repair.
So it's about optimizing the whole life of the part.
Precisely. Maximizing value, minimizing waste.
And then there's also distribution and some specialty products mentioned. What falls into that bucket?
Yeah, the segment also acts as a distributor for other FAA-approved components, which broadens their reach. And on the specialty side, you find these very specific, high-value components. Things like thermal insulation blankets for aircraft, or this advanced expanded foil mesh.
Foil mesh, what's that for?
It's critical for lightning strike protection on modern composite aircraft structures. These aren't commodity items, they're highly engineered solutions for specific demanding applications.
Okay, that paints a really clear picture of FSG. Now let's pivot to the other side, the Electronic Technologies Group, or ETG. This sounds like HEICO's more high-tech, maybe even cutting-edge division.
It definitely is. ETG is HEICO's high-technology arm. It focuses on highly engineered, mission-critical electronic, data, microwave, and electro-optical products. And the key phrase there really is mission-critical.
Meaning they absolutely cannot fail.
Exactly. These are not your everyday commodity electronics. They're specialized subcomponents designed to perform perfectly in incredibly demanding environments, deep space, a battlefield, sensitive medical gear. Failure just isn't an option.
And who's buying these? Is it mainly aerospace again, or is the customer base broader here?
It's significantly more diversified, actually, which adds another layer of resilience to HEICO overall. While there's definitely some aerospace overlap, ETG serves a broad spectrum: defense, space, medical, and telecommunications industries.
Interesting.
Yeah, and just to give you a sense of the weighting, in fiscal 2023, about 49% of ETG's revenue came directly from military agencies and defense prime contractors, so very strong ties to the defense sector.
It's easy to say high-tech electronics, but can you give us some concrete examples? What are they actually making?
Sure, it helps to visualize it. Their portfolio includes things like traveling wave tube amplifiers, TWTAs, which are vital components in, say, advanced electronic warfare systems. They also make high-voltage power supplies, which are critical for medical and industrial imaging equipment.
Like MRI machines.
Potentially, yes. Things like that. For the space industry, they develop radiation-hardened memory products for satellites. These are specifically designed to survive the harsh radiation in space where normal electronics would just fry.
Wow.
And maybe one people recognize, sadly, from news reports: the underwater locator beacons, the pingers used on aircraft flight recorders, the black boxes.
Right. Those are HEICO parts, too.
Some of them, yes. Again, products where failure is simply unacceptable.
So when you put FSG's aftermarket focus together with ETG's mission-critical components, it really feels like HEICO has deliberately built this business around incredibly stable, almost annuity-like revenue. Is that kind of the secret sauce?
That's absolutely what they've engineered, a remarkably predictable and resilient revenue engine. It's arguably one of the defining features of their model, especially within FSG. Because the demand for most of FSG's stuff isn't tied to the ups and downs of new aircraft production cycles. It's directly linked to the operational tempo of the existing global fleet.
Right. Planes flying means parts wearing out.
Exactly. As long as planes are in the air, they need scheduled maintenance, they need repairs, they need replacement parts. It's non-discretionary spending for the airlines. Safety and operational readiness depend on it.
It's not optional.
Not at all. This creates this really steady, almost annuity-like demand from airlines, cargo carriers, military operators, you name it.
So an airline can't just decide to skip maintenance or use unapproved parts to save money. What would happen?
Oh, the consequences would be severe. That's why it's non-discretionary. They'd face huge regulatory fines, aircraft groundings, and most importantly, they'd be jeopardizing safety.
And their reputation?
Absolutely. And the long-term value of their fleet. No airline wants that. This fundamental need gives HEICO really high revenue visibility and resilience. It largely insulates them from the volatility of new aircraft orders. Even if Boeing or Airbus slow down deliveries, the planes already out there still need maintaining.
Okay, that stability makes sense. And this ties into their overall strategy, which you mentioned isn't about competing head-on with giants, but dominating specific niches, this federation of niches idea.
Yes, exactly. That federation of niches approach is absolutely central to HEICO's long-term success. Instead of trying to fight it out in huge, commoditized markets where maybe only scale matters, they strategically pick smaller, well-defined segments where they can achieve clear leadership.
How do they do that?
It allows them to build these really durable competitive advantages, often through proprietary technology, deep engineering expertise, and, as we'll get into, navigating those high regulatory hurdles that just scare off most potential competitors.
And it sounds like they're careful not to become too reliant on any single niche product either. I think management said something about that.
They did. Management has specifically said they make over 50,000 different parts, and their goal is that no single product is so significant that its failure or disruption would even be noticeable to the overall company.
That's incredible diversification within the niches.
It is, and that, coupled with their technical superiority in those specific areas, gives HEICO significant pricing power. It insulates them from direct price-based competition, which helps drive those consistently high margins we see.
Okay, let's switch gears slightly. Something that always comes up with HEICO is the dual-class share structure. Can you break that down for us? How does it work, and what does it mean for control?
Right, this is an important structural point for any potential investor. HEICO has two classes of common stock, HEI shares and HEI-A shares. Both trade on the NYSE.
But they're not equal.
Not in voting power. The HEI shares get 1 vote per share. The HEI-A shares get only 1/10 of a vote per share.
1/10, okay.
And just to put numbers on it, as of late 2023, there were about 54.7 million HEI shares and roughly 83.5 million HEI shares outstanding.
So owning HEI gives you much more say. What's the practical result of that structure, especially regarding who calls the shots?
Well, the primary implication is that voting power is effectively consolidated with the Mendelssohn family. They, along with related entities, hold a controlling interest in those high-vote HEI shares.
Meaning they control the company's direction.
Pretty much. It gives them effective control over long-term strategy, major capital allocation decisions, electing directors, things like that. The HEI-A shares, while they represent the same economic interest, you get the same share of profits and value. They offer very limited influence on corporate matters because of those fractional voting rights.
And how does the market treat these two share classes?
Typically, the HEI-A shares are more liquid, more actively traded, but they've historically traded at a persistent discount to the HEI shares. That discount basically reflects the value the market puts on having that voting control.
Which is fascinating in itself. The fact that the market gives a premium valuation to a company with this kind of controlling structure. It says a lot, doesn't it?
It really does. It's a powerful signal. The market's willingness to award HEICO a premium valuation, despite this structure, is a strong testament to the investment community's deep confidence in the Mendelssohn family's stewardship over the long haul and their proven track record.
So investors aren't just tolerating it. They seem to believe that concentrated control is actually beneficial here.
It certainly seems that way. It suggests they trust the leadership and believe this structure actually aligns with, and maybe even enhances, long-term shareholder value. 2, competitive advantages and market dynamics.
Okay, so that dual-class structure and the family leadership point to a unique culture. But let's dig into the hard competitive advantages. For FSG, you mentioned the PMA mode. Just how hard is it to get that parts manufacturer approval? Is this something only a few companies can realistically achieve?
Oh, it's incredibly formidable. Think about getting approval for a new car, but you have to do it for every single bolt, every wire, every tiny component on a jet engine. That's kind of the scale of the regulatory hurdle.
Wow.
The FAA's PMA process is truly the cornerstone of FSG's competitive advantage. A PMA isn't just a piece of paper. It's a combined design and production approval. It's legally required for any non-OEM to make and sell replacement parts for certified aircraft.
So without it, you're just locked out of the market.
Completely locked out. You have to prove beyond any doubt that your part is every bit as safe and reliable as the original OEM part.
And that's not just a matter of making it look the same.
Not even close. It's an incredibly rigorous, technically demanding process. It requires huge engineering resources, deep technical expertise, and significant capital investment. The sources outline 3 main paths to get a PMA.
Okay, what are they?
First is identicality by licensure. This means getting a license from the OEM for their design data.
Which probably doesn't happen often. Why would GE give HEICO their blueprints?
Exactly. It's rare. So the other 2 paths are much more common for HEICO. Second is identicality by reverse engineering. Here, you have to demonstrate your part is identical in every way: materials, dimensions, performance to the OEM part. Often involve taking the original part, analyzing it down to the molecular level, and perfectly replicating it.
Painstaking work.
Incredibly so. The third path is test and computation. This involves submitting your own design data and then proving its airworthiness through exhaustive structural and performance testing, similar to certifying a whole new aircraft.
So these are multi-year, multi-million-dollar efforts for each part.
Potentially, yes, depending on the complexity. Most companies wouldn't even attempt it. And HEICO's advantage isn't just technical skill, it's also the deep established relationship and track record they have with the FAA, built over decades. That trust allows for maybe more efficient processing than a newcomer would get. It's almost impossible for someone else to replicate that quickly.
That really does sound like a fortress, a regulatory fortress. Okay, so that's the barrier. Now, the market itself, the commercial aerospace aftermarket where FSG plays. How big is this space, and what are the key trends driving its growth?
It's a massive market, and it's growing consistently. Forecasts suggest the global aircraft aftermarket parts market could go from around $54 billion in 2025 to over $93 billion by 2032.
Wow, that's nearly double.
Yeah, it translates to a compound annual growth rate, a CAGR, of about 8%. That's very robust, signaling sustained long-term demand.
What's behind that kind of growth? Strong global air travel must be a big piece.
Absolutely. That's trend number 1. Global demand for air travel just keeps climbing. Boeing projects passenger traffic will more than double over the next 20 years. More traffic means more planes flying more hours.
Which means more wear and tear, more maintenance.
Exactly. More flight hours directly translates to more maintenance needs, driving demand for HEICO's parts and services.
But here's something interesting you mentioned earlier. OEM production constraints. We hear a lot about Boeing and Airbus struggling to deliver new planes. How does that actually help HEICO? It feels a bit counterintuitive.
It is counterintuitive, but it's a crucial dynamic right now. The big OEMs, Airbus and Boeing, are definitely facing significant production hurdles and supply chain headaches. Think about the ongoing issues with the 737 MAX program delaying new aircraft deliveries.
Right.
The direct result: airlines are forced to keep their existing, often older, aircraft flying longer than planned.
And older planes need more work.
Precisely. Older aircraft inherently require more frequent and more intensive maintenance. So, paradoxically, the OEM struggles actually create this powerful tailwind for aftermarket players like HEICO. More demand for repairs and parts for planes that might otherwise have been retired.
It's almost ironic, isn't it? An airline's headache becomes HEICO's opportunity. It really shows the complexity of this ecosystem.
It does.
And are there other broader trends, like maybe cost efficiency or sustainability, that also play into HEICO's favor?
Definitely. Cost management is huge for airlines, especially post-pandemic and with inflation pressures. HEICO's PMA parts, offering that OEM equivalent quality at a lower price, are incredibly attractive.
Makes sense.
And then there's the growing availability of used serviceable materials, or USM, from retired aircraft. This offers another cost-effective repair option and aligns nicely with sustainability goals, reusing parts instead of always making new ones. It hits both the economic and environmental buttons for airlines.
Okay, that covers FSG well. Let's shift back to the Electronic Technologies Group, ETG. They operate in defense and space electronics. How's that market looking? What are the key drivers there?
That's a very resilient market and technologically very dynamic. Projections show it growing from around $232 billion in 2024 to $246 billion in 2025. Not quite as explosive as the commercial aftermarket rebound, but steady, solid expansion.
Yeah, the drivers. Geopolitics must be a big one.
Huge. The primary drivers are pretty clear. Rising global defense budgets, largely due to geopolitical tensions and conflicts, widespread military modernization programs happening everywhere, and the critical, ever-growing need to counter sophisticated cybersecurity threats.
So it's not just about buying new tanks and jets, but maybe more about upgrading the electronics in existing ones.
That's a major shift we're seeing. Militaries are prioritizing upgrading existing assets with advanced electronics rather than just focusing solely on buying entirely new platforms. And that's right in ETG's sweet spot.
What kind of tech trends are important here?
Key trends include integrating AI into defense systems, the huge proliferation of unmanned systems, drones, cognitive electronic warfare, and this constant push for miniaturization, optimizing size, weight, and power, or swap.
Right. Wow.
ETG's portfolio in areas like C4ISR.
Command, control, communications, computers, intel, surveillance, reconnaissance.
Got it. That, plus electronic warfare and space systems, puts them right in the middle of these powerful trends. And with North America still being the largest market for defense electronics, ETG's strong U.S. presence is a definite advantage.
Okay, so let's talk competition. In FSG, it sounds like HEICO is essentially competing with the original giants GE, Pratt & Whitney, Rolls-Royce. How do they pull that off?
It does feel a bit like David and Goliath sometimes. The OEMs are the primary competitors, dominating the aftermarket for their own parts. HA's strategy is brilliant, though. Leverage those hard-won PMA approvals to offer parts that are functionally identical, fully interchangeable, but at a better price, often with better service and availability.
So they attack the OEM's pricing power and closed ecosystem.
Directly. It's a very effective challenge.
Are there other public companies doing something similar that investors might compare them to?
Yes, the most direct competitor with a similar successful model is TransDigm Group, ticker TDG. They also focus on acquiring proprietary high-margin aerospace businesses with big aftermarket exposure. They also usually command a premium valuation for similar reasons. TDG is probably the closest comparable.
Okay, TransDigm. And for ETG, the electronic side, is the competition similar or is it different?
Much more fragmented over in ETG. It's a mix of large and small players, domestic and foreign. Some definitely have greater financial resources than HEICO.
So how do they compete there?
Competition in these specialized niches is less about price and much more about factors like unique design, cutting-edge tech, quality, absolute reliability, and deep customer satisfaction. It's about who provides the most robust, trusted solution for a very specific, critical need.
Got it. Any other peers mentioned?
Other diversified aerospace and defense firms like Curtiss-Wright, CW, and Howmet Aerospace, HWM, are sometimes considered peers, but they tend to have broader, less focused portfolios compared to ETG's niche concentration. 3. The financial pulse and growth engine.
All right, we understand the business, the competitive dynamics. Let's get into the numbers. HEICO's financial performance is consistently called out as remarkable. What does that pattern look like? Consistent growth.
It's really a story of consistent and profitable growth over decades. They've shown this incredible ability to not only grow the top line, the revenues, but also maintain and often improve their already industry-leading profit margin.
Even through downturns.
Even through various economic and industry cycles, yes. And all while generating substantial cash flow. This isn't luck, it's the result of disciplined operations and strategy execution over a very long time.
Talk about that revenue growth. Has it been steady or has it picked up steam recently, maybe linked to those aerospace tailwinds?
It's been impressive for a long time. Think a compound annual growth rate around 16% from fiscal 1990 through 2015.
16% CAGR for 25 years. That's huge.
It's phenomenal, but what's really compelling is the recent acceleration, fiscal 2024. Consolidated net sales surged 30% to a record $3.86 billion.
30%.
Yeah. And crucially, this isn't just acquisitions driving it. It's a healthy mix of strong organic performance from the existing businesses and contributions from acquisitions.
Can you give an example of that mix?
Sure. Look at Q2 fiscal 2025. They reported 15% year-over-year sales growth overall. That broke down into a really powerful 14% organic growth in FSG, showing that aftermarket strength plus 4% organic growth in ETG, and then the rest came from recent acquisitions. It really shows they can grow both ways, organically and through M&A.
Okay, growing sales impressively, but are they doing it profitably? That's often the challenge, right? Especially with recent inflation and supply chain woes.
This is where HEICO really shines and kind of validates that high-quality compounder label. Despite those industry headwinds, they haven't just maintained margins, they've actually expanded them.
Really? Expanding margins in this environment?
Yes. Consolidated operating margin was 21.1% in fiscal 2023. It improved to 21.4% in fiscal 2024, and in Q2 fiscal 2025, it hit 22.6%.
22.6% operating margin. Wow. What does that tell us about their pricing power?
It tells us they have significant pricing power. To consistently expand margins like that from 21% to over 22.5% in just a couple of years during this period, it signals they're selling essential solutions where, because of their competitive position and those regulatory moats, they have more control over pricing than most.
Especially in FSG.
Particularly FSG, yeah. Its operating margin hit 24.1% in Q2 2025. That robust commercial aftermarket demand is flowing straight to the bottom line.
Okay, so making money and doing it very efficiently. Does that translate into strong cash flow? Are they a cash machine?
Absolutely. HEI-A is a prolific cash generator. And a key sign of their earnings quality is that their cash flow from operations consistently and significantly exceeds their reported net income.
Why is that important?
It's a hallmark of a high-quality, capital-efficient business. It means they don't need huge amounts of capital spending or working capital relative to their profits. For example, Q2 2025, cash flow from operations jumped 45% year over year to $204.7 million. Their net income for that quarter was $156.8 million.
So much more cash generated than reported profit. What does that let them do strategically? Does it help fund their growth without taking on tons of debt?
Precisely. This powerful cash conversion is the lifeblood of their growth strategy. It provides the capital to fund that steady stream of acquisitions, which is core to their growth engine, without needing excessive debt or constantly issuing new shares and diluting existing shareholders.
And they manage their debt well, even after big acquisitions.
Incredibly disciplined balance sheet management. Even after that huge $2.05 billion Wencor acquisition, they brought their net debt to EBITDA ratio down rapidly. By April 2025, it was at a comfortable 1.86x. That was way below the sub 3.0x they initially anticipated right after the deal closed.
So they can pay down debt quickly, keeping flexibility for the next deal.
Exactly. It preserves their financial firepower.
That strong cash flow clearly feeds into their capital allocation strategy, which you said heavily prioritizes M&A. Just how active have they been on that front?
Mergers and acquisitions are, without a doubt, the primary engine of HEICO's growth and their #1 priority for capital. Since 1990, they've completed somewhere between 98 and 100 acquisitions.
Nearly 100 deals.
Yeah, an incredible track record of identifying, buying, and integrating these niche businesses. Management always describes their M&A pipeline as highly active. They're constantly looking for opportunities that fit their strict criteria.
What are those criteria? Are they just buying growth, or is it more strategic? And what's this owning forever idea?
Definitely not just buying growth. It's very strategic. They target businesses that broaden their product lines, expand their tech capabilities, or give them access to new customers, and markets always aligning with that niche dominance philosophy. Key criteria include potential for continued growth, strong cash flow generation, and getting them at what HEICO considers fair prices. Very disciplined on valuation.
And the owning forever part.
That's a defining feature. They've famously only sold 2 businesses since 1990. It reflects a true long-term owner's mindset, not a private equity buy-and-flip approach. They buy these businesses with the intention of holding and growing them indefinitely.
That really is telling. Can you give some recent examples of these deals?
Sure. That big $2.05 billion Wencor deal was a major one for FSG, really scaling up their commercial aftermarket presence. But they also do a steady stream of smaller bolt-on deals, like acquiring Gables Engineering, an avionics maker, and Rosen Aviation, which makes aircraft interior displays both for ETG, adding high-tech lines, or Millennium International, an avionics repair specialist, for FSG.
So it's a mix of big strategic moves and smaller bolt-ons.
Exactly. And it creates this virtuous cycle. Strong cash flow from existing businesses funds the purchase of the next one. It just perpetuates itself.
M&A is clearly the main engine, but they also invest internally in R&D. How significant is that, and is it different between the two segments?
While M&A gets the headlines, internal R&D is seen as absolutely integral to their organic growth. It's foundational. In fiscal 2023, they invested about $95.8 million total in R&D.
Okay.
But there's a noticeable split. $26.4 million went to FSG, and a much larger $69.4 million went to ETG.
Why the big difference? Does ETG just need more R&D for its products?
Pretty much, yeah. It reflects the different nature of the segments. ETG needs that higher R&D spend to maintain its technological edge in cutting-edge defense, space, and medical electronics. Innovation cycles are faster there.
And FSG's R&D.
FSG's R&D is more focused, more applied. It's primarily dedicated to the complex engineering needed to develop those new PMA parts, the reverse engineering, the testing, and finding those alternative DER repairs. It's a different kind of innovation, focused on efficiency and cost effectiveness within that established regulatory framework.
Given all this reinvestment back into the business via M&A and R&D, what about direct shareholder returns, dividends, buybacks? Or is the philosophy truly reinvestment beats payouts?
Direct returns are clearly a secondary priority. They do have a long, consistent history of paying a semi-annual cash dividend. They just raised it 9% in June 2025 to $12.12 per share. So there's a commitment signaled there.
But the actual amount is low.
Very low, intentionally. The resulting dividend yield is tiny, consistently below more 0.1%, and the payout ratio is only about 5% of their earnings.
So definitely not an income stock. That low payout must be a deliberate message from management.
It's a very clear signal. Their philosophy is that reinvesting earnings back into the business, mainly through those accretive acquisitions, will generate far superior long-term returns for shareholders via capital appreciation compared to just distributing cash as income. It's all about long-term compounding.
And how do shareholders react, especially given the dual-class structure?
It's interesting. While some might prefer bigger dividends, the market giving HEI-ICO that premium valuation suggests a large part of the investor base actually agrees with this strategy. They trust the Mendelssohn's track record of compounding value more than they want the immediate income.
What about share buybacks?
They have authorization for buybacks and use them opportunistically, but it's definitely not a primary or programmatic use of capital like M&A is.
4. The landscape ahead, opportunities and risks.
Okay, so HEICO is this well-oiled machine, proven strategy. Let's look at recent performance and the road ahead. They've had some record-breaking growth lately, right? Especially post-pandemic.
They absolutely have. HEICO's performance recently has been exceptional. They've really capitalized on that strong commercial aviation recovery and the sustained demand in defense and space. It's been a series of record quarters, often beating expectations.
Can you give us some highlights from, say, the last year or so?
Sure. Take the second quarter of fiscal 2025, ending April 30th. Net income was up 27% year over year, hitting $156.8 million. Net sales also jumped 15% to a record $1.1 billion for the quarter.
And that was driven mostly by FSG's organic growth.
Largely, yes.
Yeah.
That 15% overall growth included a remarkable 14% organic growth in FSG, plus contributions from acquisitions. It really shows that powerful ongoing demand for aftermarket parts and services as airlines ramp up flying globally. And beyond the financials, there was that big governance move recently, the succession plan with the Mendelssohn family. How did that unfold?
Yes, that was a key development. In May 2025, they executed their long-planned succession. Lawrence Mendelssohn, who built the company over 30-plus years, moved from CEO to executive chairman. His sons, Eric and Victor Mendelssohn, both longtime senior execs, became co-chief executive officers.
How was that received? A smooth continuity?
Mostly, yes. It was presented and generally seen as a deliberate, well-planned transition, ensuring stability and continuity in leadership and strategy.
Now, even with all this success, no company operates in a vacuum. What challenges or headwinds has management pointed to recently? Things holding back even faster growth.
Right. Despite the great results, management consistently flags ongoing supply chain constraints as a persistent headwind. They've actually said it's holding back even faster growth, implying demand is outstripping their ability to get certain things.
Interesting. Anything else?
Additionally, the ETG segment, specifically its non-aerospace defense parts, went through a period of customer inventory destocking in fiscal 2024. That temporarily slowed growth there as customers used up existing stock, but management seems to think that's largely behind them now.
Okay, looking ahead then, where are the big growth opportunities for HEI-ICO? Seems like they have a long runway given their position.
They really do. Several key growth vectors. First, just continuing their core strategy in FSG, developing new BMA parts and DER repairs. That remains the biggest organic opportunity. There are still thousands of OEM-dominated parts out there for HEI-ICO to potentially target and take share.
What about expanding geographically? Any focus there?
Definitely. While they're already global, there's significant potential for deeper penetration into high-growth international markets. Boeing's forecasts point to places like Eurasia, South Asia, Southeast Asia having the fastest-growing demand for commercial aviation services in the coming decades. That's a clear target for HEICO.
And for ETG, any new tech areas or adjacent markets they could leverage their capabilities in?
Yes, ETG's advanced tech provides a platform to enter emerging aerospace markets. Think things like advanced air mobility or AAM, the whole flying taxi
Right.
space.
Right.
Also, the rapidly growing commercial space sector, which demands high-reliability electronics, and potentially other specialized high-tech industrial applications that need that same kind of mission-critical performance.
And M&A. Still a major opportunity, or are targets getting harder to find?
M&A absolutely remains a key growth driver. The aerospace and defense supply chain, especially at the subcomponent and specialized service level, is still remarkably fragmented. That means there should be a continuous pipeline of potential niche, high-margin targets for HEICO's bolt-on strategy for years to come.
So lots of opportunities. But every investment has risks. What are the main potential headwinds or risk factors investors should keep in mind for HEICO?
It's crucial to consider the potential vulnerabilities. Even for a strong company like HEICO, there are material risks. First, and maybe most critical for FSG, is regulatory risk.
Because their whole PMA model depends on the FAA.
Exactly. The entire FSG business relies on that FAA PMA framework. Any significant change making approvals harder, more restrictive, that could fundamentally damage their competitive advantage.
What about safety perception? What if there's an incident involving any PMA part, even if they're not HEICO's?
That's a real risk, too. A high-profile aviation incident linked to any PMA part could lead to increased regulatory scrutiny across the board and maybe a flight to OEM safety preference among airlines, at least temporarily. That could undermine confidence, even if HEICO's quality is perfect.
Okay, regulation is one. What about competitive threats? Do the OEMs ever fight back harder?
That's the competitive threat. OEMs are the main competitors, and they could get more aggressive, maybe lower their own part prices, offer more attractive long-term service deals bundled with new planes, or lobby for regulations favoring their own parts.
Ban competition for deals.
Right. Highly capable players like TransDigm run a similar acquisition playbook. That could increase competition for the best M&A targets, maybe driving up prices.
We talked about the aftermarket stability, but is it totally immune to big economic shocks or another pandemic?
That leads to aerospace cyclicality. While the aftermarket is definitely less volatile than new plane sales, it's not completely immune. A severe global recession or another black swan event like COVID that causes a sharp, sustained drop in flying hours would reduce MRO demand and hit FSG's results. Resilience is high, but not absolute.
And given their heavy reliance on M&A, there's always M&A execution risk, right?
Right.
Finding good deals, integrating them well.
Absolutely. That reliance introduces execution risk. Finding the right targets at fair prices gets harder as they get bigger. A misstep, overpaying for a big deal, or fumbling the integration could destroy value and tarnish that great track record.
Finally, what about customer concentration? Relying on big airlines and defense contractors.
Yes, that's common in this industry, but still a risk. HEICO depends on major airline and defense customers. Losing one or more key customers or seeing them significantly cut back business could materially affect the company. It's something they manage carefully, but it's inherent to the sector. V, valuation, and the Mendelsohn legacy.
Okay, we've covered the business, the strong competitive position, the solid financials. Now, the big question for many, valuation. HEICO stock consistently trades at a hefty premium. How do we make sense of that?
That really is the core question for anyone looking at HEICO, isn't it? The stock consistently trades at a premium, reflecting the market's extremely high regard for its quality, growth, profitability, and management.
How high are we talking compared to its own history?
If you look at its historical context, its current trailing PE ratio is around 75x. That's significantly above its own 10-year historical average, which is closer to 49x.
75 times earnings.
Yeah. And other multiples, price to sales, price to cash flow, price to book, they're all trading at or near the high end of their 10-year ranges too. It clearly signals exceptionally high market expectations, priced for continued excellence basically with little room for error.
So definitely not cheap historically. How about compared to its peers? We mentioned TransDigm, Curtiss-Wright, Howmet.
The peer benchmarking really highlights the premium. Using numbers from around mid-2025, HEICO's EV to EBITDA multiple is around 38x, PE around 76x. Now compare that to TransDigm, its closest benchmark. TDG also gets a premium EBITDA of about 24.4x, PE around 42.3x.
So HEICO's PE is substantially richer than even TransDigm's. Why the big gap, do you think? They seem quite similar in many ways.
That's a great question. It's nuanced. TransDigm often uses more financial leverage and has historically favored large debt-funded special dividends for shareholder returns. HEICO runs with a more conservative balance sheet and reinvests almost all its cash flow into that steady stream of bolt-on acquisitions. So the valuation gap might suggest the market puts a higher premium on HEICO's lower risk balance sheet and its consistent, repeatable M&A growth model, maybe seeing it as less reliant on debt compared to TDG's model. It could be a preference for sustained growth over leveraged returns.
And compared to the more diversified peers like Curtiss-Wright and Howmet.
The premium is even more pronounced there. Curtiss-Wright trades around 27.6x EV/EBITDA, 41x PE, Howmet around 36x EV/EBITDA, 58x PE. HEICO is significantly higher than both.
Why such a difference there?
It likely reflects IHO's greater, more focused exposure to that lucrative commercial aftermarket, its superior historical growth rates, and its consistently higher profit margins compared to those more diversified companies. And if you compare IHO to the overall A&D industry median, which is way down around 13.6x EBITDA and 24.7x PE, its exceptional status is really stark.
Okay, it truly stands apart. So what's the ultimate bull case? How do you justify the premium valuation? What does the market see?
The bull case essentially argues that HEICO is simply a superior business that deserves a superior multiple. That premium is payment for a unique combination of attributes.
Like what?
1. Consistency and predictability, that long, uninterrupted track record of double-digit growth. 2. Defensible moats, especially those high regulatory and technical barriers in PMA. 3. Superior profitability, consistently high margins and returns on capital. 4. Aligned management, that proven, long-tenured family team with significant skin in the game. And 5. A long growth runway, that clear, repeatable strategy for growth through M&A in a fragmented industry.
So the market sees it as a high-quality compounder.
Exactly. A business capable of reinvesting its capital at high rates of return for a very long time, driving sustained value creation. That's what commands the premium.
And how would a sum of the parts analysis fit in here, looking at FSG and ETG separately?
Conceptually, it's useful. While a detailed SOTP model is complex, the idea is you'd value FSG and ETG separately using multiples from their respective peer groups. FSG, with its aftermarket focus and moats, would get benchmarked against TransDigm, warranting a high multiple. ETG would be compared to high-end defense industrial tech firms.
And the result would likely support the overall valuation.
Likely, yes. An SOTP analysis would probably confirm the market assigns a premium to both segments individually, and maybe even an extra bit for the synergistic benefits of the combined company's shared management discipline, potential cross-selling, things like that.
Let's talk more about that aligned management, the Mendelsohn legacy. How significant has their continuous leadership been?
It's been profound. They've shaped HEICO's culture and strategy for over 3 decades, since taking control in 1990. Lawrence Mendelsohn led as CEO for most of that time, recently moving to executive chairman. His sons, Eric and Victor, who were already deeply involved as executives, are now co-CEOs.
And that succession was seen as planned continuity.
Yes, very much presented that way.
What about their personal investment? That skin in the game, how much do they own, and does it truly align them with other shareholders?
That's a critical piece. The Mendelsohn Reporting Group, the 3 key execs and family entities, beneficially owned about 16.5% of the high vote common stock as of early 2025.
16.5%, that's substantial.
It's very substantial. This creates a powerful alignment of interests. Their personal wealth is directly tied to the long-term performance of HEICO's stock. It fosters that unwavering focus on sustainable value creation over just hitting short-term numbers. This owner-operator model is a big reason for the market's trust.
How does this play out in their executive compensation? Does it reflect that long-term focus?
They describe their approach as common sense, aimed at motivating executives to grow profits, cash flow, and market cap long term. The structure includes base salary, performance-based annual hash bonus, stock options, and long-term plans.
What are the bonuses tied to?
Critically, for fiscal 2024, the annual bonus for the top execs was explicitly tied to hitting at least 10% year-over-year growth in 3 key areas: net income attributable to HEICO, EBITDA, and cash flow from operations. That direct link ensures their incentives align with operational success.
And it's interesting you mentioned they seem responsive to shareholder feedback, even with that controlling structure.
That was a positive sign. The 2024 proxy statement noted that, based on shareholder input, they didn't issue any stock options to top execs that year, and they signaled a shift towards more performance-based equity grants in the future rather than just time vesting.
So they are listening, despite the control.
It demonstrates an attentiveness, yes, which is good governance.
And finally, transparency. Do they provide the standard info investors need?
Yes, they adhere to standard public company practices. SEC filings, regular quarterly earnings calls, a comprehensive IR website with reports, presentations, governance docs. Investors have the necessary information to track performance and strategy.
Synthesizing the risk-reward profile.
Okay, so bringing it all together. After this deep dive into HEICO, how do we synthesize the risk-reward profile? What are the final takeaways?
Well, this analysis really shows HEICO as this uniquely positioned, exceptionally managed company in attractive markets with very high barriers to entry. That competitive advantage in aftermarket parts, rooted in the FAA's PMA process, looks highly sustainable and is incredibly hard for others to copy.
And even strengthened by current OEM issues.
Right, those OEM production delays paradoxically help them by keeping older planes flying longer. Management has also proven they can navigate challenges like supply chain issues and inflation, still expanding margins and fueling record growth through that disciplined strategy.
So the reward for an investor, what are they buying into?
The reward is ownership in what you could genuinely call a best-in-class industrial compounder. It has a proven, repeatable formula for long-term value creation, durable competitive advantages, operates in markets with strong secular tailwinds, and has that highly aligned, respected management team. It's a truly exceptional business.
But every investment, especially one priced like this, has a flip side. What's the primary risk here?
The primary risk, especially at current valuation levels, is that premium valuation. The stock price seems to fully reflect all the operational excellence and the great track record. It implies a long runway of continued, almost flawless execution.
Meaning there's little margin for safety.
Exactly. There's very little margin for safety baked into the current price. Any significant slip-up, a bad acquisition, an operational issue, a negative industry shift, or even just a broader market pullback on high-multiple stocks could put significant pressure on the share price. You're effectively paying for perfection and betting they can keep delivering it for a long time.
So after diving deep into HEICO's remarkable story, its regulatory moats, its acquisition engine, the family leadership, what does this tell you, perhaps, about looking for value in overlooked corners of the economy? How might you spot other federations of niches that might be quietly building incredible, durable value, maybe becoming the premium companies of tomorrow?